Welcome to the Passive Investing Made Simple Masterclass. Today, I have a question. Have you ever really thought about is passive investing really truly passive investing? Because here's the thing, the truth is there are a lot of things about passive investing and earning passive income that no one talks about. And today we're going to talk about what it means to be a strategic passive investor. What do they do differently? Now, I do this show live every Tuesday to help you learn the ins and outs of passive real estate investing, how to turn your active income into passive income and long-term wealth. So maybe you've tried investing passively before, but just couldn't get comfortable making the investment, or you've actually invested in a deal before and discovered later that it wasn't the right fit, or you simply wish to sharpen your skills. If that's you, you're in the right place. Now, a little bit about me. I've been investing in real estate since 2002, and I've acquired a pretty sizable portfolio, but I do it for one thing, that is to spend time, have the freedom and choice to spend time with my crazy crew here. We love traveling. We love seeing the great outdoors. And I have documented my journey in my book, Money for Tomorrow. So if you are wanting to dig in more about how I was able to build my portfolio, check that book out on Bigger Pockets or on Amazon. You can snag it there. But really, all of that investing, scaling that portfolio, both actively and passively, has allowed me one result, and that is how could I scale a portfolio that allowed me 100% choice and freedom on how I spent my time? That is the centering question for any investment I make. Now, that's not how I started out. I actually started off like, hey, let me get the biggest returns I possibly can, which meant I had to be very actively involved in my fix and flips, in my house hacks, all of that. But then at some point in time, I was like, wait a second. I'm not in this to have another job. I'm in this to actually get my time back, get my attention back. And I'm going to show you how to do the same here on the Passive Investing Made Simple channel. Now, we can actually help you do that in passive investing if you want to, take a look at some of our equity investments or debt investments. That is something that we help our investors do. So be sure to check out our passive investing club. There, you can hop on a call one-on-one with me. We can talk about your investing goals, give you access to our private deals and tools to help accelerate your growth. Now, I do this masterclass as education for you. Okay, so today we are going to talk about what I call the LP system. What system should you have in place as a limited partner? Now, if we dive into any numbers, please don't construe it as tax advice, legal advice, financial advice. Make sure you take all this education back to your investing team before making a decision. All right, so you're interested in passive investing. You want to scale a portfolio, but you're just sitting here kind of racking your head. Somebody somewhere, some YouTube video somewhere told you all you have to do as a passive investor is find a good operator, write a check, and then sit back and collect the return. But that's the thing. There is actually a hidden job here as a limited partner, okay? Yes, we were all told. I remember being told that earning passive income is simple. Income just shows up. It's mailbox money, right? You write it, you buy a single family rental, you put it with a property manager, you get mailbox money. You invest into a limited partnership, and then you get mailbox money, and life just gets easier. But here's the thing. At some point in time, you might start feeling really stressful, confused, like something's missing. And here's the thing, you're not alone, okay? The truth is that most passive investors start getting into real estate, be it single family rentals, small multi, even larger commercial passive deals, and then realize that there's actually a job description here for them, okay? And by not knowing what that job description is at the very beginning, it's cost them time, confidence, and maybe money. All right. So today we're going to cover what it means to be a strategic limited partner. What are your real responsibilities here? What is the five-part strategic, what I call LP operating system? We're going to connect you with some strategic tools and then actually help you see that some of the blind spots that limited partners have as they start investing. All right, the first thing we always have to tackle here is mindset. Okay, if you're in financial, space at all, everybody's talking about you have to be a good investor, you have to have the right mindset. But here's the thing, most people, when they get in this space, they feel like they think they're being strategic, and actually, they realize what they're doing is they're just carrying the habits that they had in place when they invested it through, say, their retirement account into Wall Street assets. They're carrying that over to private placements, stocks, and syndications without actually truly understanding that there's a mindset shift here in the investment process. So name this. What actually goes wrong is that when we're investing in stocks, bonds, and mutual funds, especially starting off, like if that was your first introduction to quote unquote passive investing, you were probably chasing returns. You weren't necessarily looking at all the different stock tickers that were making up a particular ETF or a mutual fund. Okay, you weren't understanding how that aligned with your capital's purpose. Now, you might actually expect the operator to provide clarity for your investment plan before you actually establish it for yourself. That's another thing that, we kind of bring over from Wall Street investing. We have fiduciary advisors that tell us what our risk profile should be. They tell us, oh, you're 30, you're 35, you're still in the accumulation phase. You have plenty of time to make this up if you have an issue go wrong in your portfolio. And then another habit that kind of becomes confusing is that we confuse access to deals as a verbose strategy. Okay. We don't, and we get okay and comfortable with handing off responsibility, as opposed to we should have a funnel of access to deals, and we should be narrowing that down really well to what fits our goals, risk, and timeline. All right. Now, if this is you, it was me. Okay, I'll raise my hand first. This was me when I first started making this transition from stocks, bonds, and mutual fund investing to becoming a strategic limited partner. You might get pretty humbled in the beginning, okay? And that's fine. I want you to know you are right where you are supposed to be. Let's fill in the gaps, build those skills to get you moving forward, okay? Here's the thing. As a strategic limited partner, the mindset shift that we need to have here is you don't need to operate the deal to make a return, okay? But you do absolutely need to understand and hold true to your investment thesis. You have to understand the deal. You have to hold true to your investment thesis. So that means we do have a little bit of work here. All right, now, as we move into our strategic 5-prong limited partner operating system, we first have to put a lens on it. And the lens is, what type of passive income are we going to be acquiring, like going after here? Now, if you're here listening to me, you're probably wanting to be invested passively in real estate, but let's go ahead and name the other two buckets. One are the paper assets, stocks, bonds, and mutual funds, maybe even REITs. Now, here's the thing. Okay, that these have places in people's portfolios, but just you need to know that they can be volatile. Okay, you have low control of your capital placement, meaning you're not the one picking the assets. Somebody else is picking the assets. Okay, some fund manager somewhere is picking the assets. All right, but here's the thing: it feels good. There's some warm and fuzzies here because they're can be highly liquid. All right. Now, a little asterisk here, not all REITs are highly liquid. All right, then another type of passive income is residual income. All right, this is you scaling your own business, scaling yourself out of your own business, maybe developing a piece of content or a book or music and getting royalties off of it. Or maybe you develop something and get a patent, okay? Okay, that is another type of passive income. That requires a ton of active upfront work. Most people are not cut out for it. And then you have to continually market that, okay, to continue to get the business income, the royalty income, continue to benefit from the patent. And they can be really time and attention heavy. Okay, that is another bucket of residual income. Most people are not cut out for that. If you are, kudos to you, because it can be very profitable. But then we've got our cash flowing assets. Okay, this can be like debt, preferred equity, real estate. Now, not all of these are cash flowing. At some point in time, we would expect to get some sort of cash flow from it. But here's the thing, as a limited partner, if you're wanting to invest in these things passively, okay, these assets are pretty ideal for the limited partner. Why? Because you actually get to control the capital placement, right? You get to choose from the menu of what assets are going directly into your portfolio. Okay, some fund managers not doing that. You are doing it. Now, they're low operational demand. Okay, once you get your upfront work done, that's awesome. And there's low attention required, but I didn't say no attention, just low attention. So what is that attention that we have to put into the system? Okay, now remember, we're not operating, but we still have to put some sort of energy into here. Okay, there's 5 steps that you as a limited partner need to maintain. And guess what? Going back to the title of today's presentation, most limited partners don't know that they need to do these 5 steps. They think, I research a deal, I invest in it, I'm done. Sit back and let the money hit my bank account. No, we have to put time and energy into the system, but it's low attention, which is huge, and you maintain control of the capital. All right, so first step of the system is the capital strategy, okay? We have to define a specific purpose for your money. You have to give every dollar that you're gonna invest a job. And we're gonna talk about those jobs here in a second. Then our risk and allocation, okay? We have to position our capital according to our personal risk tolerance and risk capacity. Okay, so just because you have a high risk tolerance, if you don't have the, if you can't afford to lose that dollar or take the risk to lose that dollar, okay, you don't have high capacity. So we got to reconcile those two. We'll talk about how. And then we have our decision-making filters, okay? And then and most people are talking about decision-making filters. Those are due diligence systems. Okay, we have plenty of boot camps really diving into due diligence. Monitoring, okay? Once you understand your goals, risk, and timeline, have put together your due diligence systems, then you got to monitor the investment, okay? Tracking the performance. How is it still aligning with your goals? All right, we've talked about that recently in one of our boot camps. So make sure to find that video on tracking and monitoring in our YouTube channel at passiveinvesting.com, D-O-T-com on YouTube. And then we actually have to make the decision about portfolio strategy, okay? So weighing all these different, as capital continues to come back to us, how are we going to continue to grow and pivot our portfolio? What decisions are we going to make about our liquidity, taxes, reallocation, all of that, okay? So this is how your money gets direction, not just a destination, okay? We're continuing to give it a direction to go out into the world, work for us, come back to us. We get to make the decision on like if we're going to reinvest it and continue to grow. This is how you grow your portfolio with intention. All right. So step number 1, capital strategy. What is the job of your money? Again, most LPs, when they step over into the passive investing space, they're coming from stocks, bonds, and mutual funds. This may be you, and you're like, I want the highest return for my money, okay? I'm in my 40s. I still have 15, 20 years before retirement. I want to still take a lot of risk here. And that is where sometimes we don't quite understand that there's other things we need to think through when it comes to the job of our money. One, do we have the liquidity in place? Okay, do we have our reserves covered for emergencies, but also a little bit set aside for opportunities that continue to come our way? We shouldn't ever be dry powder, like no powder on the sideline to be able to invest. We should always have a bucket of cash flow coming back at us that we can continue to deploy. All right. And then income generation. A lot of people move from, this may be you, investing in stocks, bonds, and mutual fund. You get into syndicated investing and you're like, get it all invested in equity. And then you think about, wait a second, I actually need some reliable cash flow coming in. Should I ever want to or need to step away from my job? I was talking with a friend of mine yesterday. We were talking about me doing a main stage presentation at our conference. And she was like, could you connect the dots, for people that they must invest in passive investing? I'm like, yeah, it's not all about retirement. I had my husband break his neck and my mom die in the same week, and I had to step away from my job for 6 months in order to take care of everything that was around me. Oh, yeah, I had a 4-year-old at home too. Okay, so sometimes what I tell limited partners, how I coach them is like, let's make sure we got a layer in there for income generation. The what ifs that can also translate into retirement income. And if you don't need that income right now, cool, we can harvest it, reinvest it, continue to grow. All right, another capital strategy, growth and appreciation. We should have a bucket once we've taken care of our liquidity needs, our income generation needs, or at least have that bucket starting to build for us. Yes, we should have part of our portfolio focused on growth and appreciation because that's going to help us build that long-term wealth. Now, notice we did not start off with tax sheltering. Tax sheltering is like throwing gas on the fire, okay? But you got to have the fire first, all right? Learning how to protect earnings from unnecessary taxation, that is a second tier strategy. We've got to have the core strategy going first, and then we can create velocity through tax sheltering. Now, you may have sold your business or sold a piece of real estate and you're coming into a capital gain, maybe we move tax sheltering a little higher up the list, but generally it's never the first thing there. We always have a liquidity, income generation, or a growth strategy ahead of us. All right, so then we get into our capital matrix, right? Right, so once we understand which bucket we need to allocate in, what are the appropriate investments we should be looking for in these buckets? So if we're talking about liquidity, AKA safety, okay, we want to maybe look at the high yield savings accounts, CDs, money markets, whole life insurance policies, because that gives us optionality and peace of mind. If we're needing that stable income bucket, okay, we're going to be looking for cash flowing debt opportunities, liquid debt placements, no penalty, associated with them should we liquidate. That's going to allow us to enhance our lifestyle or possibly even replace our income. If you're looking to allocate money into the growth side of things, we're going to be looking at probably equity replacement, preferred common equity, both of those, value add real estate. Okay, these are more long-term legacy type plays. Okay. All right. Those, we're moving up the food chain here. Okay. So we don't want all of our investments in the growth strategy if what you need is income. And then the top tier, tax optimization. Okay. This is more of a tactic that lays on everything, where we take advantage of cost segregation, bonus depreciation, maybe some tax credits. That's why we love real estate. Okay. But that is a net return enhancement. And it can help create cash preservation and velocity, but it is not the core capital allocation here. All right, so step 2, risk and allocation. All right, this is another thing that I really wish I knew about or really fully understand when I transitioned from stocks, bonds, and mutual fund into passive real estate investing is looking at all the different things that could possibly keep me up at night and derail me from my investments. Okay, part of that is your time frame. Where are you in life? Okay, how much time do you have to recoup a loss? Okay, and let's balance risk accordingly to that. How comfortable are you with risk? Even in my 20s, I wasn't very comfortable with taking risk. I know people told me all the time, Whitney, you've got 20, 30, 40 years to make up before you retire, make up an investment loss. And I was like, wait a second, I just earned this dollar. I don't necessarily want to take a huge swing with it. Okay, so we have to create alignment there. Okay, we have to align our choices with your psychological capacity to ensure peace of mind. The question I always ask myself here, what will allow you to sleep well at night? Okay, let's not violate that. And then, of course, our ability to handle loss. Okay, many a times I've talked to a passive investor. They're getting in the space and they have $100,000 to invest. They're talking to an operator. The minimum is $100,000 and they write a check for $100,000. They bet the house on the one investment. That's that's a huge risk. I don't think they really understand how much risk they are taking there. So we want to make sure that as we're entering the passive investing space, okay, the truth is that you need to create diversification, okay, amongst deals to kind of hedge your bets, right? We don't want to jeopardize the overall health of your portfolio. All right. Then we move into things that I think, as passive investors, you come into the space, you're like, yeah, I get it. Everybody's talking about how to vet an operator, how to vet a market, how to vet a deal. Okay. Yes, everybody has their due diligence checklist. But what are the actual filters on what we're making decisions? Okay. It's not just about having a robust checklist that you're looking at deals. As a strategic limited partner in your LP operating system, we're actually trying to suss out the 7 pillars of wealth. How well does this deal match up to the 7 pillars of wealth? How well does it preserve my capital? Okay. Rule number one of investing from Warren Buffett, don't lose money. Rule number two, see rule number one, right? So we want to make sure we're safeguarding our investment. Number two, cash flow. How well does that investment kick off cash flow? All right. Now, you may not need the cash flow, but I always argue the cash flow will show you how stable that investment is in today's market environment. Even if it just breaks even, that's still stable. Okay. But we want a clear plan to grow. Number three, is there any equity potential here? Right. That will allow us to build long-term wealth. Now, don't mistake that we should invest in one deal and it gives us all 7 pillars. Okay. If it does, that's putting us up the risk chain. Okay. But we want to have as many pillars as we can in each one of those capital tiers that we talked about earlier. And then diversification, smart use of leverage, tax benefits. And then, oh yeah, who's the person running the deal? Is it you? Are you the expert? Are you investing with an expert? All right. So I wanted to pause right here because these are the first 3 steps that we want to have in place. And at this point in time, you're going to be writing a check to a deal. Okay. The truth is, you need a quick little filter here to double check yourself before you write that check. Does that deal match your capital allocation, your purpose, your clarity? Okay. Is it in the right part of the capital stack that you want to be investing in? Does it match your risk? Does it match your goals? Does it match your timeline for investing? And then does it match your risk allocation and capacity? You got to be able to say yes to all 4 of these questions before writing the check. Okay. I wish as a passive investor starting out, I had a quick, like little limited partner filter like this to help me quickly assess if I should be investing in a deal. All right. Once we invest into a deal, now the other 2 parts of our system are more like monitoring and adjusting. Okay, so our monitoring system, we're going to have quarterly responsibilities, annual responsibilities, and then just kind of ongoing tasks. On a quarterly basis, we should be checking in to make sure we got all the income and return that we were expecting. Okay, so we need to have a way to track that. We need to be looking at the operator updates. Now, most operator updates in my portfolio come on a monthly basis. Okay, but at minimum, I'm looking at those quarterly. I want to be tracking the performance metrics. All right. And then also, if I have capital coming back at me, like in cash flow or equity, I'm probably going to have another investment to place. So I'm going to continue my capital planning process. All right. So I'm going to go back to the beginning here. And then deploy that capital into new investments. Okay. Now, this does not have to be complicated. If you watch my video on passiveinvesting.com on YouTube, you will see my 15-minute tracking spreadsheet that I put together. It does not have to be complicated. This can be super, super streamlined and simple. All right, on an annual basis, I want to sit down for a couple hours and really look at my portfolio. Okay. Again, this is me as a limited partner taking ownership over the process. I want to make sure that I'm going to double tap and make sure that all my investments still align with my timeline. Now, remember, they're illiquid more than likely, but as capital cycles out, okay, now do I need to move that capital into a different tier? Am I overweighted on the growth tier? I need to put it into more cash flow, predictable cash flow tier. Have I had to deplete my reserves for whatever reason? Do I need to take some of that cash flow and equity and build up my reserves again so I can get back to generating cash flow and equity? Which is number two, make sure we are checking our reserves, that they're adequate. All right. And then every year checking in with our CPA, get that tax strategist. Okay. And I do this at the end of the year in November, very specifically. Why? So I can make some quick adjustments before the end of the year, possibly, but more importantly, plan for the entire following year. Okay. I'm not waiting until like a month before the tax deadline to sit down with my tax strategist because there's very little I can do. All right. And then, on an annual basis, making sure there's no portfolio rebalancing that I need to do. Now, ongoing systems here as a limited partner, okay? Use what you got in front of you. Set up filters in your inbox. I have in my Gmail inbox, I have everything that's deal update related from any of my deals hits a folder in my account. Okay, everything's filtered and goes there. And so every week, at the end of the week, I can just open up that folder and see what updates have come in. Okay, so I'm making things very streamlined and easy for myself. I've got calendar appointments on my calendar to do monthly reviews, quarterly reviews, my annual review. Okay, and it's actually the same time every single week. It's just that weekly, it's a half hour. Monthly, it's 1 hour. Quarterly, it's 2 hours. And at the end of the year, it's 3 hours. I just expand that time on the exact same day of the week. And then we talk about that dashboard that I've already referred to you a couple of times. And then also, as you learn things about your investing, don't hold on to it in your head. I want you to have a running document of lessons learned, because I want you to feed all of those lessons learned back into your investment thesis. Okay. And why I don't want you holding it in your head is because you might forget. Two, we ruminate on things and it gets more blown out of proportion than maybe it really truly is. Okay. But more importantly, we want to capture those lessons and learnings so you can update your investor thesis, okay, how you're allocating your capital and make better decisions. All right. So to sum it up, your entire portfolio strategy, this whole LP process is really about making sure that you have thought through the different layers of your portfolio cake. The liquidity layer, your cash flow layer, your growth layer, your tax optimization layer. The tax optimization layer are like the flowers on top, okay? No single asset will do all of these for you. I mean, possibly yes. However, if they do, it's going to be in the tip top tier of your cake, probably highest risk, higher reward. So we want to make sure we have good allocation across these layers. All right. So just a quick recap as we wrap up is, again, make sure that we are executing the LP operating system. Okay, this is the truth, the hard truth, that people that are that people that have transitioned from stocks, bonds, and mutual fund and become really seasoned passive investors, They learned all these lessons along the way. I'm helping you shortcut that path. One, make sure you know exactly what your capital needs to do in your portfolio. Okay, take a pause if you don't know that. If you need to loop in, your team, your tax and legal team, do that before investing. Understand what layer of the portfolio you're investing in, which layer that capital cake that we just looked at. What's your timeline look like? Okay, as you invest, what is your time alignment? And then your risk alignment. Okay, how much can you take in from a risk tolerance perspective, but also from a risk capacity perspective. Being a strategic limited partner is not luck, it is skill. These are the skills that YouTube shorts and Instagram 90-second reels don't teach you. So if you want to learn more, if you want to connect with me, you can reach out to me at passiveinvestingwithwhitney.com. There we can jump on a call and discuss your investing goals. If you're here live, don't go anywhere. We're about to start the Ask Me Anything part of your show. Ooh. Oh, Lisa. Hi. Thanks. All right. Q&A. Yeah, if you guys are here live, jump in, ask questions. It can be in relation to the topic that we covered today. It can be about something else, and we will see what rabbit hole we go down. Somebody asked, how can I get a copy of the presentation? All of our shows are recorded on our YouTube channel. If you're here, you've registered for the show, you will get the video recording. So there you go. Oh, great. I'm glad you guys found great value out of it. I always ask, what did you love? What would you have loved to have seen? Because that's super helpful for me. Because if there's something missing here, let's make sure we get it addressed. So question came in, are we just experiencing the oversupply in the multifamily sectors? I would tell me a little bit more context about when you mean, are we just experiencing that? I'll read into that. As far as like, if the question is why aren't we seeing more multifamily deals? I think there's still a lot of uncertainty in the bond market. Interest rates haven't fallen, and so if somebody's trying to acquire a new property, the deal might not, pencil out. Also, until interest rates drop a little bit more, current operators can't, it's a little bit more difficult for them to recapitalize their projects if they don't already have that going with their lender. And it might, and again, if they're trying to sell, it might make it a little bit more difficult for somebody else to come in and buy. So if we're talking about um, just the recovery of multifamily, it's hard to in some markets there is a lot of oversupply, right? We're still seeing a lot of deliveries that need to be absorbed through 2025, probably Q1 of 2026. But I would say largely most markets have generally started to recover from the oversupply. But one market in particular, like Austin, like they're going to be in it probably. I think all their deliveries are supposed to be absorbed by like mid 2027, so it's going to be a while there. Yeah, Lisa, yeah, great information. I believe the decision filters will help me a lot. Thank you so much. Fantastic. Do you ever use a logic process diagram to capture the entire process along with the decision points? I think that format might work better for me. I try to walk simplicity here, give people just enough of a process that's easy to execute without overwhelming my people that are not like into spreadsheets and like Gantt diagrams and stuff like that. So it really depends. My engineers are like, Whitney, too simple. And my other people that are like, a different walk of life, they're like, Whitney, it's too complicated. So I really try to give people just enough of what they need without overwhelming the process. And so, really, if you are, let me See how quickly I can right here. This is the core of the slide, right? Or the presentation, right? You got to have a plan for your capital. You got to know your risk and allocation. You got to have your decision filters in place. Most people, when they invest passively, they start here. Oh, let me borrow somebody else's due diligence checklist. Ask them a couple questions about well, one, they if they're smart, they actually get their decision filters. But the problem is those due diligence checklists are based on somebody else's goals, not theirs. Oops. Okay, I did that. Um, and then they're probably not monitoring their portfolio very well, and then they're wondering why they have no strategy. So really, we need to back it up and understand what's your capital strategy, your risk timeline and allocation. Then you tailor the due diligence to your own, what you need, right? So, if you are somebody who needs a ton of cash flow and you don't really care about the equity growth, you are going to go super deep on the cash flow questions and maybe just ask enough equity questions to feel comfortable. But somebody who's like really, dialed in on the equity growth side of things, that's what their bread and butter is. That's what they want. They're going to maybe go, "Oh, okay, great. It has a little bit of cash flow. Check." Then they're going to have to go really deep on the equity questions. Okay. So we want to make sure these are dialed in, but those are the big buckets we're checking. Then we got to have that monitoring process. Okay. Again, we're trying to think through how is this a strategy as opposed to, oh, I kind of like that person. They seem like they do a good job. Let me write them a check and see how it goes. That's what we're trying to avoid. Um, oh, even okay, so back to our question about multifamily absorption and all that. Construction start is declining. Yup. Whenever we saw whenever interest rates started rising 2.5 years ago, that really put a damper on construction starts. Okay. If somebody wasn't already in the permitting phase or even had the ground broken, it was going to take them a long time. Okay. Um, so that, when we look at our market cycle, and we've taken a look at that graph several times, construction really doesn't start coming back until the expansion phase. So construction starts to, there's only really one phase construction starts really do well in, and that's the expansion phase. In the hypersupply recessionary recovery, construction starts kind of coming back online in the recovery, but it's very slow. Okay, the other part of the question here is the rents continue to have downward pressure and not recovering. That's market dependent. Okay, so if you still have a lot of hyper supply in the market, which means everybody across the board is fighting for the same tenant to go into their multifamily property. Okay, or we can even apply this to self-storage, hotels. It doesn't matter. If you're competing, if there's a lot of hyper supply, you're competing for the same customer, you're going to see a stagnation or a downward pressure on rents for sure, or whatever that income variable is. So until absorption, deliveries are complete, absorption, everything, all the butts get in the seat, all the people get into the apartments, then we're going to see rents to start take off. But that may mean that you have to wait like a year or two for more people to move to the area or more another employer to come in. So there can be a lot that goes into these puzzle pieces for sure. What is one thing a syndicator has said to you that made you decide not to invest with them? Oh, what one thing? Mm, for me, I'm always a trust but verify. I want to trust what people are saying, but I'm going to verify. And if they don't give me the data to verify, then that's probably the biggest thing that's going to prevent me from, me investing with somebody. So, if I'm asking for specific details and they can't deliver it or won't deliver it for whatever reason, um, you know, there's very few reasons that should preclude somebody. Like maybe if it's a closing, and they have signed a confidentiality agreement, and they can't share a particular spreadsheet. I can kind of see that, but anyways, again, trust but verify. That would be my biggest stickler, because I want to be able to check all my decision filter buckets, right? Like the first two parts of the system, capital strategy, risk allocation, those are mine, right? That I'm doing that work for me. But when it gets to the decision filter, I want to make sure I have all the information I possibly can from the operator to make sure that investment meets these filters. And if I can't get it, then I'm not going to invest. Pretty simple. When distributions are withheld and stop coming, are there other tactics to keep the portfolio working? Okay. So again, and there's a lot of different reasons why cash flow might be compressed. Okay, so if we stay here with our decision filters, um, you know, if I'm gonna potentially get my return back at a later date and still get all my capital back, cool. My portfolio technically still works. There, so let me back it up because that's really a very complicated question. I would actually put it in context with like, did you invest according to having all these different pillars, at least the first three pillars in your portfolio? So I know when I started investing passively in real estate, I was so attracted to multifamily because at the time there was huge cash flow, equity growth. It was cycling out in 2 years, right? So it seemed liquid, or liquid enough for me and my needs. But then I quickly realized through my own experience having my 40 single family rentals that, if like there was an issue for whatever reason, the income stopped, I was not in a good position. So I actually started pivoting and inserting a layer here. Instead of expecting one investment to do all that work for me, which is optimization, that's huge. I was really, really well optimized. Like I was paying nothing in taxes. And I mean, yeah, but it came at a cost because I was just one market inflection away. If there was something that happened in the market that would stop the cash flow on my equity investments, I was host. Okay, that's what we don't want. So when you say when distributions are held or stop coming, are there other tactics to get the portfolio working? I encourage you to think back to the strategy. We got to think in terms of strategy. The strategy is this. Are you liquid? Okay, do you have enough set aside for emergencies that if all your cash flow stopped on your equity deals that you can last X months or years without needing those assets to produce cash flow? Okay, most people can't. Most investors in this past cycle were cash poor. Okay, so then it is, are you peeling some of those investments aside to have an income layer to generate predictable, reliable cash flow? So this is a strategy and a tactic. So the tactic that I suggest to most people now is if you don't have the cash flow coming in and you need to have the cash flow, we got to inject some of those income generation layers. And it can come in different things. All right, you get a little bit of income from high yield savings accounts, CDs, money markets. I mean, yawn like 4%, maybe 3 or 4%. Cash flow life insurance policies, you can push that up a little bit, but it's not free cash flow to you. You can't use it to pay the bills necessarily. So how can you get more like fixed income like cash flow? That's where I like adding in like cash flowing debt layers. Our, example, our real estate debt fund. We have our pick yield fund. There's one tier of it that offers cash flow and deferred growth on it. That would be like a nice option. Okay. The piece here is we want to make sure this is flexible. Okay, we don't want it. We wanted to be liquid placements. Okay, that we could liquidate in 3, 6, 9 months, like pretty quick. We can get out of, okay, with no real penalty. All right. Now, a lot of people think preferred equity for cash flow. The thing is, preferred equity actually is in growth. I want to stay in when I go into cash flow and debt and these type of placements, I am an expense line item to that fund or to that note, to that debt holder. They have to pay me. Contractually, they have to pay me. When I go into preferred equity or common equity positions, I am not a debt. I'm not an expense line item to that deal. I'm a partner. We make money together, we lose money together. Okay. So I want to, again, this is all about understanding the strategy. Okay. And then picking the right tactic in the strategy. Hopefully that makes sense. What are your thoughts on the litigation fund? Are you talking about LPG? I don't know exactly which litigation fund. That's the only one that I know about right now. If you could be more clear, if I know about it, I'll give you my thoughts. Can I provide scan code to order my book? Yeah, it's on Amazon. Money for Tomorrow: How to Build and Protect Generational Wealth. I always include that code at the beginning, but you can find it on Amazon, Money for Tomorrow, and just type in my name, Whitney. If you order the book, I would appreciate a review. That's how other people are going to find the book for sure. All right, guys, tons of great questions today. Happy to answer any last minute questions that are here. I think we got through quite a bit.